Business Finance, Chapter 14. In Chapter 14, we talk about dividends and dividend policy of corporations. The different kinds of dividends. So we have different kinds of cash dividends. First, just our regular cash dividend. This is the cash payments made directly to stockholders, either yearly, quarterly, or semi-annually. An extra cash dividend means that this is a dividend that is extra above and beyond any regular dividends and won't necessarily be repeated in the future. A special cash dividend is similar to an extra dividend, but definitely won't be repeated. And then a liquidating dividend. And a liquidating dividend happens when some or all of the business has been sold and the amounts collected from the liquidation are used for the dividend. We have different dates related to dividend payment. So the first date is the declaration date. On this date, the board declares a dividend and then the dividend becomes a liability of the firm. And PowerPoint just crashed because, yay computers. This is like the third time my computer has crashed today. And here we are. On the declaration date, the board declares the dividend and the company records a dividend payable, which is a future liability. It's not the date that dividends are paid. The ex-dividend date happens 2 business days before the date of record. This is 2 business days before it locks down when an owner, who the owner is of a stock and whether or not they will receive a dividend. So if you buy a stock the day before the ex-dividend date, you receive the dividend, and if you buy a stock after the ex-dividend date, you don't receive the dividend. So this is to help them to establish who are the shareholders before they pay a dividend out. So they basically lock trading of the stock during that time to make sure that the dividends go to the right person. The stock price generally drops on the ex-dividend date, sometimes by the exact amount of the dividend, and sometimes taking into account that dividends are taxed as income to the person receiving the dividend. It will be a little bit less than the dividend that it drops because of that tax burden. The date of record is the date that the holders of record are determined. So that's when they establish exactly who holds the stock on that date is who receives the dividend payment. And then the date of payment is when the checks are mailed to the holders of record. You can see a timeline on the next slide here of the reaction of the stock price to the ex-dividend date. So before the ex-dividend date, the price is what's stated in the market, and then at the ex-dividend date, the price will drop approximately the amount of the declared dividend. The next question that the textbook asked is, does dividend policy actually matter? Does what a company's policy is on dividends matter? So in the one case, yes, dividends do matter because the value of stock is based on the present value of expected future dividends. We've done those calculations in previous chapters. However, the dividend policy might not matter if we're trying to decide whether we're going to pay dividends versus retain the funds to reinvest in the firm. If the firm reinvests the retained earnings now, it has the potential to grow and pay higher dividends in the future. It really depends on what kind of firm we're talking about, what kind of growth we're talking about, but just because they don't pay dividends now doesn't mean that there isn't a potential they might pay dividends in the future. And by reinvesting their retained earnings, they can use that to sustain growth of the company, future growth. Future growth means higher company value. We're going to look at an example here. So we have an all equity firm with 100 shares outstanding. Our investors require a 10% return. We have an expected cash flow of $10,000 each year, and the firm plans to dissolve completely in 2 years. The firm can either pay out dividends of $10,000 per year for each of the next 2 years, or they can pay $11,000 this year, raising the other $1,000 by issuing stocks or bonds, and then pay an amount in year 2 sufficient to provide new shareholders with a 10% return. So if we look at Plan A versus Plan B, in Plan A, we issue $10,000 a year. So our stock price doesn't change. Our expected return is 10% because the dividend per share is $100. In year 2, we issue $11,000. We raise the $10,000. We have the $10,000 from our company operations. We raise the extra $1,000 by selling more stock. We then issue $110 in dividends to our shareholders in year 1. The dividend per share in year 2 then is $89 per share. Regardless of which one we do, the expected return on that investment is still 10%. So this is an example of how the dividend policy doesn't matter for a company, whether they do Plan A or Plan B, has the same exact net result. When a company is deciding whether or not to pay dividends, they can pay a low dividend or a high dividend. Some of the benefits of receiving a low dividend payment are first the taxes. So individuals might prefer lower dividend payments because of their tax consequences. All dividends are taxed to the shareholder, so they might decide they'd rather have low dividends or no dividends. Flotation costs. So low payments can decrease the amount of capital that needs to be raised, thereby lowering flotation costs. So we don't have to raise additional capital in order to pay a dividend. So we saw that in the previous example, in order to pay the dividend in Plan B, they had to raise capital by selling more stock. And there is a cost to selling stock. They're called flotation costs. And we'll find out more about flotation costs in a future chapter. And dividend restrictions. We might have restrictions about how much we can pay out in dividends. So if you remember from chapter 6, where we talked about protective covenants that could be put in our bond documents and our bond indenture, and one of those protective covenants that can be put in is that during the time that a bond from issue to maturity, there is a limitation on how much the corporation can be pay out in dividends. So those are the various reasons that a firm might choose low dividend payouts. Well, some of the reasons a firm might do high dividend payouts. The people who own their stock want current income. So they're in lower tax brackets. They don't have to pay a lot of tax on their dividend payments versus people in higher tax brackets So the amount of tax that you pay on dividends depends on your marginal tax rate. If we go back to chapter 2 when calculating marginal tax rates, groups that are prohibited from spending the principal of investments and can only um, spend the amount earned on an investment. Those examples are trusts and endowments. So nonprofits and educational institutions often have endowments where they're not allowed to spend the principal amount of the gift and they can only spend what is earned on the principal that's been invested. They want to have high returns because they're only allowed to spend whatever they receive in dividend payouts. So the higher return, the better it is for those types of groups. Uncertainty about the future of the company. So maybe we don't believe that the company will ever pay higher future dividends. We don't think they're going to grow. We don't have any promise that they're going to grow. So we'd rather receive high dividends now. And then, but on the other side of taxes, we have a dividend exclusion for corporations. So when a corporation buys stock in another corporation, the dividends that they receive from the corporation they bought stock in, they have a tax exclusion on those dividends. So individual people have to pay tax on dividends. Corporations can receive dividends from buying stock and they get a tax exclusion that is 50% or more. It's not applied to capital gains, it's only on dividend payments. So they get a very nice tax exclusion on the dividends. They would favor higher dividends. And a lot of it's just the investor preference. So some investors prefer low dividend payments, some investors prefer high payouts. And investors are going to seek out the companies that meet their dividend preferences. So this is another reason that it really doesn't matter what a company's policy is because there's going to be someone somewhere who's going to be interested in investing in them versus their policy. Now, this question, what do you think will happen if a firm changes its policy from a high payout to a low payout? Well, if the main reason that the investors bought that stock is because of a high payout, the investor would sell that stock and switch to another investment. Same thing with the other one. If I was an investor who didn't want a high payout and my stock changed from a low payout to a high payout, I might change to a different kind of payout. A stock repurchase is when a company buys back shares of its own stock. This is also sometimes called treasury stock, where we repurchase shares of stock, we've reduced the number of shares outstanding. The company can buy back its stock in many different ways. One is in the open market. So this is just the open market where every investor can buy stocks. The company just buys its own stock at the current market price. In a tender offer, the company states what price they will buy stock at and the number of shares that they will buy at that price. And then investors can decide whether or not they want to offer their shares for sale. So for example, say that a stock is on the market for $10 a share. the company can come and say, for a limited time, we are going to buy back 10,000 shares at $12 a share. And the first 10,000 stocks that are purchased back at $12 a share, then they stop buying back. The investor who decides to sell their shares back gets a better than market return on those. And the other one is a targeted repurchase, where the firm repurchases shares from specific shareholders. Maybe they're trying to reduce the percentage ownership of specific shareholders. So we know from earlier chapters that this might be a reason where we're trying to prevent a takeover of our organization by investors getting too high of a percentage ownership. So we might go to them directly and try to reduce the percentage of ownership that they have. A repurchase returns cash to the stockholders just like cash dividend does. Okay? However, unlike dividends, it doesn't have the same cost as dividends have. It would just be a straight repurchase. The individual investor may have to pay capital gains tax on that versus the tax that they would have to pay on dividends. But there is not a charge to the company for making the cash dividend versus the repurchase decision.